Are you invested in the S&P 500? If you are, you might have wondered, are you diversified enough? All everyone ever talks about when it comes to investing is diversification and the importance of it. And I understand the importance of diversification, but one thing that you might be asking yourself, and something that I've asked myself before, is the S&P 500 diversified enough? Well, after watching this video, you should know the answer to that question. And if you have any other additional questions, please feel free to leave them in the comments below. Let's first start by talking about what the S&P 500 is, just so we're all on the same page here. The S&P 500 basically is 500 of America's largest publicly traded companies. Not necessarily the largest 500 companies, but 500 of the largest publicly traded companies. So the S&P 500 is what's known as an index. And usually if you're invested in that S&P 500, you are investing in an index fund that tracks the S&P 500 or tries to mimic it. So actually the S&P 500 is quite large. It is a market share of about 75% of the entire US. That's enormous. Just these 500 publicly traded companies represent about 75% of the market share in the United States. That's insane. But still, we need to know if that is diversified enough for the individual investor. And speaking of diversification, let's also really quick just recap on what diversification is and the importance of it. Now, we're not going to go into depth on it, but basically the idea of diversification is to spread your risk. The more companies that you're invested in, the more things that you are invested in, the less your risk is, because you're kind of not putting all your eggs in one basket, as they say. And the idea behind it is that not only do you minimize your risk, but you also can maximize your returns, because if one portion of your portfolio is not doing so well, another portion of it might be doing so well. So for example, if stocks are going bad, maybe if you are diversified in bonds, the bonds are doing well. Or maybe if the bonds are doing bad, the stocks are doing well. Or maybe if both of those are doing bad, maybe real estate's doing well, or and so on and so on and so on. So diversification is kind of one of the cornerstones of good investing, especially for individual investors. And proper diversification definitely means more than just stocks. But really in this video, we are talking about the S&P 500, which represents 500 companies, so they're all stocks. And before I move on, I just want to say this is the kind of thing that this channel is all about. On Cash Flow is all about investing, saving money, growing your net worth, and pretty much anything that has to do with personal finance. And if that is something that interests you, I definitely invite you to subscribe to the channel, because every single week I am putting out new information on personal finance, including stuff like this in investing on Tuesdays and Fridays, currently at 3 p.m. Pacific Standard Time. So consider subscribing if that interests you. And so far, if you're liking this video, I'd really appreciate it if you did actually like the video on YouTube. It really helps me out and motivates me to keep making these videos. Let's get back to it and talk about diversification. Well, the S&P 500, as we know, like I have stated, 500 companies, about 75% of the market. But to be better diversified, an individual investor should probably consider investing in the total stock market. So the total stock market, it's kind of hard to invest in every single company, even if you're investing in an index fund, because small companies can pop up, become publicly traded, and then go away very quickly. So it's not easy to invest in the entire US stock market. But the next best thing we have is index funds that actually track the stock market, like actually track the total stock market. And that's personally what I use myself. So the Dow Jones, if you ever heard of that, they actually have, besides the Dow Jones Industrial, just 30 companies, the Dow Jones actually has a total stock market index as well. And these total stock market funds, they actually track about 20% more than the S&P 500. So you're actually getting diversified to up to 95% of the entire total market in the United States of all companies. So that's amazing. And usually it's actually those smaller companies that are going to return a lot higher than some of these big gigantic 500 companies, over the long run. Definitely small companies, they come and go a lot more often. And those 500 large companies, they're probably not going to be going anywhere soon. Now, I'm not saying that's not possible. It's definitely possible. Any company can go under and disappear anytime. But really, these small companies, over time, historically have performed better than large companies. And then they become large companies, hopefully. Introducing yourself and having a little bit more by investing in a total stock market index might be a better move diversification-wise for an individual investor. And that's personally what I do. I don't invest specifically in the S&P 500. I choose to invest in a total stock market, index fund. So I am exposed to more of the US market. And these total stock market funds, they do include a lot more smaller companies, but really it only excludes like the smallest and tiniest companies. Let me put a chart up here for you just so you know that I'm not just making things up. You can see on this chart the actual annual average return pretty much since inception. You can see all the way from 1990 up until almost 2019. You can see the annual returns of the different amounts, and actually large cap stocks are actually at the very bottom. Now they're actually still pretty very good on return wise, but you know, the smaller companies, the smaller they get, the more of a return you're going to have because the more risk you are taking. And even still, if you do choose to purchase a total stock market index rather than just the S&P 500, it's not like a large portion of that is going to be small companies. So the actual stock market index seeks to invest as a market share. So still within your portfolio, those S&P 500 companies are still going to take up pretty much 75% maybe of your actual portfolio, and all those smaller companies are going to be, you know, tiny fractions of a percent of how much it is actually as a portion of your portfolio. So you're still getting, you know, some exposure to those smaller companies. It still might, in theory, return you a smaller, like slightly larger return than just the S&P 500 alone, while at the same time, you know, maybe minimizing your risk a little bit more because it's so more diversified and creating better returns for you at the same time. You know, nothing is guaranteed, of course, but it's not like once you're investing in a total market versus the S&P 500 that it's just, you know, you're barely invested in any of the S&P 500. No, it's still a very large portion of a total stock market index. And you can check that out yourself if you actually go and look at, you know, what's contained within an index fund. You can see that those large companies still make up a very large percentage of the total stock market index funds. Another question that you might have had is, what about international diversification? And this one, really, it just depends. The answer on it just kind of depends on who you ask. So argument number one is generally seen as, you know what, these large US companies, they're already multinational. You know, they're already invested overseas. So you're kind of already invested overseas just by being invested in just the S&P 500 or a total stock market index. And while that does hold some merit, you're definitely not going to experience the same returns as you would if you actually invested in an actual international total market fund or something like that. Because international companies and different markets around the world, they usually are kind of correlated to the US market because it's kind of like the primary market, but while at the same time, they can experience, you know, different busts and booms on their own. So there is definitely potential for more return by investing internationally rather than just sticking to the US, even though US companies are multinational. But that is going to be something that you're going to need to do the research on and decide for yourself. I do actually allocate some of my portfolio to solely international companies, usually more developed companies, but yes, I do have a total international stock fund that I invest in myself. Still, my total market US fund definitely dominates my portfolio. And speaking of asset allocation anyway, you know, if you go to say what's the best asset allocation, you're going to get a ton of different answers from a ton of different people. I myself, I can only tell you what I like to do. I like to keep things as simple as possible, and so I kind of follow the 3-fund portfolio. And really what the 3-fund portfolio is total US stock market, total international stock market, and total US bond market. So that is kind of what my portfolio is. I try to keep things as simple as possible, and maybe it could be right for you. Maybe it's not the most optimal, but at the same time, it's pretty darn well. It's been doing pretty well for me over the years, and it might do well for you. So just do your own research on what the asset allocation that's going to be best for you will be, because it's going to vary from person to person based on a multitude of different factors. I do not think the S&P 500 is diversified enough for individual investors because we can actually very easily invest in a total stock market index fund and choose to opt into that rather than just the S&P 500. And I believe that is the best choice for me, and it might be the best choice for you as well. But what do I know? I'm just some guy on YouTube, right? But I can already tell if you are interested in this kind of video, I have another video that I know will be interesting to you. And it is about financial independence, which is basically about growing your wealth and becoming just generally wealthy and financially secure to where you can have enough money to support yourself in the worst case scenario. So if you are interested in this video, I know you're going to be interested in that video. It should pop up right next to me just about now. So definitely check it out if investing is interesting to you. And if you enjoyed this video, please don't forget to like it if you haven't already. Consider subscribing to the channel because I'm putting out new information every single week, currently Tuesdays and Fridays at 3 p.m. Pacific Standard Time. And I know that there is going to be something that I can help you with. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.